For more on the latest market moves as stocks near all-time highs here, let's welcome in Michael Darda, Roth Capital Partners Chief Economist, Macro Strategist. Mike, it is always great to have you on the show. Maybe, Mike, we'll start with that economic data we got here today and that decline in jobless claims. Interesting to get your take on this, Mike, because I did see some economists, they saw that data, Mike, and they were telling their clients, listen, bottom line, the pace of layoffs is historically low. It's not accelerating. Take a deep breath. The labor market is not as weak, they were saying, as some economists are suggesting and perhaps fearing. Your response to that, Mike?
Absolutely. So thank you guys for having me on. The jobless claims data, I mean, if you just look at first-time claims, looks phenomenal, bulletproof, right? Very low levels recently have been pulling back. So if you look at first-time claims in isolation, it really doesn't look like there's anything wrong with this labor market whatsoever. Unfortunately, that is not the whole story. Earlier this week, we got a report out of the Conference Board that have some indicators that directly tie to the labor market that are also telling us something about September, and that data weakened pretty precipitously. A big decline in the present situations index and the labor market differential. They go out and ask people if they think jobs are plentiful or hard to get, and that differential correlates very closely with the unemployment rate and pushed up to new highs for the year. And we also saw a bump in the August readings, so that would be consistent with the unemployment rate continuing to creep eventually towards 5%, and that would throw us back into the recession alarm bell camp if that ends up playing out. So unfortunately, we have mixed data points here. The GDP revisions that you both were talking about will look pretty good, but that's backward looking. Some of the more contemporaneous data, not first-time claims, that data still looks good, but we got data out of the Kansas City Fed and the Richmond Fed for manufacturing for September, missing expectations and looking pretty sloppy. So it's a bit of a mixed bag, but risk markets want to believe in the soft landing story, so we've been making new highs anyway.
Yeah, it's all about what markets believe, isn't it? Mike, I want to come back to what you were talking about the perception of jobs plentiful versus jobs hard to get. That's a number we were talking about as well from the Conference Board this week. And one investor we spoke to said, well, this is just the normalization process from the sort of very unbalanced job market that we saw during and then after the pandemic. How are you thinking about sort of what is a normal job market, what's a healthy job market, kind of sustainable at the same level?
Well, that's really an important part of the discussion here. The levels are still healthy in the sense that the unemployment rate is at a very low level historically, but it has been moving up in a persistent way. And when that happens, you have an economy that tends to be growing below trend or below the growth rate of potential. And it's very unlikely that that kind of a thing plays out in just sort of steadies at a level that we think is healthy and consistent with a soft landing. It doesn't mean it won't happen this time, but we're 0.8 of a percentage point off the trough on the unemployment rate, and we're still at a historically low level here in the low fours. But business cycles are about the direction, the rate of change, not just the level. So if you're coming off really low levels but inflecting upward, that still tells you something important about the business cycle and the threats to the business cycle. So we have a tremendous amount of optimism here with the major indices at record highs, that the soft landing is playing out, that it will continue to play out. I think a hard look at the data really leaves more questions there than answers, but obviously hope springs eternal. So we'll see what the next few jobs reports tell us. If we see the unemployment rate start to level off or even start to roll over again, that would be different. Typically, when you go up as much as we've gone up from the lows, you continue moving higher. And so the history hasn't totally been written here. So let's see what the next few data points bring us.